Hello and welcome to the Leaky Bucket podcast. I'm your host, Ian Morgan, and I'm here to make accounting fun and practical. With over 15 years of experience as an accountant and a business owner, I'm excited to share tips and tricks that will help you improve your financial controls and gain the clarity that you need to succeed. So let's plug those financial leaks and take your business to the next level. Stay tuned for some great insights. Hey there, and welcome back to another episode. So, I just wanted to today run over that whether you are a small business owner or you're running a company with millions of pounds worth of turnover, then today's episode will show you why allocating 1.5 to 2.5% of your revenue to your finance function is essential. And if you're thinking, wow, that's a lot, then just stick with me. I've got some real world stories to prove that it's worth every penny. So, first of all, why your finance function deserves investment. So, why should you actually invest in your finance function? And what does that even mean? Well, when I say finance function, right, what I'm talking about is your financial reporting, your bookkeeping, your cash flow management, your tax compliance, your software systems, and yes, even the accountants who make sense of it all. Now, a solid finance function is the backbone of any healthy business. Without it, you're likely operating on really shaky ground. Accurate financials, they help you make informed decisions, help you stay on top of your cash flow, and they also help you avoid nasty surprises like fines, any tax issues, and even potentially cash shortages. So, real scenarios from the field. So let's get into some real world scenarios where businesses have paid the price for not fully investing in their finance function. Now, these are all clients who have come to us after struggling with major issues. I've anonymized them all, but these are all real scenarios that happened because they didn't put enough attention or resources into their financial management. Okay, so first of all, this one was let's call them a landscaping business, okay? And they came to us with no real up-to-date bookkeeping. They were behind on VAT payments to HMRC, and they were constantly taking out loans just to be able to stay afloat. Now, when they sort of brought us on board and they asked us to dig into their sort of financials, we spent a bit of time, first of all, just getting the most recent, like the last 6 months data, just up to date, just to see where things were at before we went through a big mass project to catch up going sort of far back. And what we found quite quickly were the profit margins were low, right? Alarmingly low. Just 3% net profit and 20% gross profit. Now, by getting that sort of that 6 month period in date, right, with up to date with proper financial data, we can help them benchmark against industry standards. So we've got access to some industry standard data. We've also got other clients within the same industry. And we also know how general service-based businesses perform because that's our general speciality. And what we were able to recognize quite quickly is that business wasn't viable in its current form. That needed to be restructured and move forward. But the idea is, right, if you're going to restructure and move a business forward, there's no point in taking the old mistakes and then just moving them into the new business, right? That doesn't make sense. So what we had to do was make sure that they learn exactly how they get their pricing right, how that they can structure the price increases and communicate that effectively. So we went through what that can look like, how to communicate it, how to be having those conversations. And then I'm glad to say that today they are operating with a 20% net profit and a 50% gross profit margin. And it's a huge turnaround. And all of that started due to solid financial management. Now, what they've been able to do now going forward is that because we are on top of that data, when they pull the various different levers that you can pull in a business to change things, they can actually manage and monitor the results that that brings. In terms of like, we've made this change, does that have a positive or a negative effect on the margin? Right? Okay, and in turn, we've made this change, and so on. The second example I'm going to give you is a therapy-based business. And they had, or they didn't even realize, I suppose, that they'd managed to, it was, I suppose, what's the best way of putting it? This was the case where basically they had been using an American Express type credit card to be able to use that effectively for the business and gain back points, right? So lots of the company costs, where possible, were going through this to be able to generate additional cash back and points and so on. They were managing that and doing all of their bookkeeping using Xero as a cloud accounting platform. But the accountants, when it came to the year end, they didn't know and understand Xero, so they were just like, "Oh, we're just going to ignore it." So they went off and they did their own way of doing things, right? And they just took all the bank statements for the year and they classified everything, and that was it. They presented it to the client to sign off. The client didn't necessarily know what they were looking at. Roughly looked sensible to them. It's quite a large business. And they were just like, okay, fine. And off they signed it off. Anyway, trust started to erode and they come and spoke to us, right? And we dived in and we had a quick look, delved through all the bits, and we were like, where's the credit card balance? It's not in the accounts. Anyway, through diving into that, we managed to find that over £300,000 had been spent on that credit card relating to business transactions, genuine, legitimate business transactions, had been misclassified as director's loans. This had led to over £60,000 of additional corporation tax that shouldn't have been there, and also potential personal tax liabilities of over £110,000. Right, so you're talking £170,000 of additional tax that this client shouldn't have needed to pay due to, in our view, an underinvestment in the accounting function. Okay. Now, once we've stepped in and managed to correct this, right, we're seriously getting the business back on track. However, that's been difficult for the business to make decisions. They thought they were more profitable than what they were. There's been some elements of fat, I suppose, that's allowed to creep into the business through thinking that the profits were higher. And therefore, they've not been able to understand why the cash flow is not there. Obviously, this element has highlighted a bit of an issue in the business, but being able to get on top of the financials and making sure that they're in play means that actually this business can really understand where they're performing and how to move that forward. So now I want to move on to a bit more of the cost of not investing, right? So as you can see, the consequences in these two examples of underfunding your finance function can be severe. There's another example as well. We've also worked with a holiday letting company that the previous accountants had completely missed an entire bank account from their accounts, right? A whole bank account. And this came up because one of our checks during our onboarding process is to make sure that all of their bank accounts for the business are all on Xero. And when we questioned this, they went, "Oh no, there's this bank account that's not on there." Okay, simple question, when did they open that bank account? And it was like 18 months ago, right? And what goes through that bank account? So we've delved in. Actually, this resulted in undeclared sales of nearly £100,000. Now, in this case, this means that they owe additional tax. It also means the business is probably performing far better than what it was previously. But this slip up, I suppose, or this error could have led to major fines from HMRC. And instead, we've managed to help them avoid the penalties, and we revealed that their business was actually performing far better than they realised. And there's also a software company that we were dealing with, right, where due to a transactional relationship with the accountant, where advice wasn't in place and wasn't to be given. It was just like, you get on with it. We'll just deal with the transactions as they happen. They were paying themselves a very inefficient salary of over £120,000 a year. When they came on board to us and we were able to restructure that into a salary dividend combination, but targeting their net earnings, we were able to therefore lower the salary dividend combination significantly and saving them over £15,000 a year in tax. And I'm not going out there and pretending that's anything magic, right? That's simple, efficient, and effective tax planning. But the levels of services that exist between different accountants is significantly different. You've got that sort of transactional element where it's just you do the work, you just basically manage and do everything, and we will just file the tax return at the end of the year. There's no tax efficiency or anything like that. Then you start to get to bringing in a little bit more tax efficiency and helping you sort of manage those elements. And then it goes right up to like finance function, CFO services, where really we're helping you get into the business and understand how your business is performing. And then there was also a financial comparison service business. And this was probably one of our most challenging cases. That in the financial sector, they're basically outside of the scope of VAT. And therefore, they hadn't realised with some of the changes of where we'd left the EU and reverse charge VAT. And I don't want to get too complex on this. But basically, because of the level of spend that they'd got on advertising that was outside of the UK, they had inadvertently triggered having to register for VAT on a partial exemption. And therefore, they came to, when we discovered this through a conversation with them because of a mutual client, we actually discovered that they had an underdeclared VAT bill or an undeclared VAT bill because they weren't even registered for VAT of over £250,000. The business model then, off the back of this discovery, just became completely unsustainable. The profitability just simply plummeted and it went down to such a low level. We had a bit of a strategic planning session with the director, and he's really, really good, and he's really, really clued up and capable. And actually, he saw a way that through the financial management and the helping us, sort of us getting in there and really helping him and questioning him, he could restructure the business, shrink it down from somewhere in the region of 4 or 5 million down to sort of £1 million business, but on a much better business model, and then rebuild the business from there. And what we were able to do was work with him and build what that would look like and how the business could improve. And now we're talking about a business that is operating with much, much improved profit margins, probably 4 to 5 times where they were previously. And it's in a much, much healthier position. The business now is also starting to get back to those same levels of turnover. So it's really hitting profits that it's never hit before. So what's the lesson here, right? Well, the key takeaway is that your finance function isn't just about keeping the book straight. It's about enabling your business to grow and thrive. And in our view, by investing that 1.5% to 2.5% of your turnover into finance, like we mentioned earlier, it's not just the accountant, it's maybe your in-house accounting team, it's the software, it's the overall finance function, then you're safeguarding your company's future. The alternative? Well, as I've just mentioned, it can mean costly errors, fines, missed opportunities, and overall potentially an underperforming business. You've got to think of your finance function like the foundations of a house. You just wouldn't skimp on it, because with skimped foundations, your house could fall down. And your business is no different. With the right financial support, then you can focus on what you do best, growing your business. I just want to say thanks so much for joining me today on this deep dive onto why investing in your finance function is, in my view, non-negotiable. If any of these scenarios sounded familiar, then it might be time for you to take a hard look at your financial operations and consider where you can improve. Don't wait for that crisis to happen. Go and get proactive. If you want to learn more about how we can help you invest wisely in your finance function, then head over to our website or reach out to us directly. Let's get your business on the right track today. Thanks so much for taking the time to join us for this episode today. We will continue to bring you great tips and tricks in future episodes. But if you can't wait until then you can always head over to our Facebook group and join the conversation with fellow business owners and entrepreneurs. Just search Accounting Tips and Tricks on Facebook or check out the show notes. Until next time.